All right. Good evening, everyone. I will now call to order the March 26th, 2026 regular Finance Commission meeting. Tatiana, please take the roll call.
Commissioner Giuliani,
Here.
Commissioner Ho,
Here.
Commissioner Rubin,
Here.
Vice Chair Quaid,
Here.
Chair Stanton Trahan.
Here.
We have quorum.
Thank you. All right. Let's go start with public comment. In an effort to better manage the business on the agenda, general public comment will be limited to 30 minutes at the beginning. If there are speakers remaining in the queue, they will be heard at the end of the meeting. If you'd like to make a public comment for items not listed on this agenda, please submit a public comment card or raise your hand via Zoom. Tatiana, are there any public comments in person or on Zoom?
No, we have no public comments on Zoom nor in the chamber.
Great. Well, let's get going. All right, let's move to the consent calendar. So items listed under the consent calendar are considered by the Finance Commission to be routine in nature and will be enacted by one motion unless a public comment has been received or a commissioner. Anything going on? Oh, commissioner requests otherwise, in which case the item will be moved for separate consideration. Do we have any members of the public wishing to speak on a consent calendar item?
No, we don't.
Any commissioners have any comments or questions for items under the consent calendar?
Yes, I do. Item 4.
Item 4. All right, we'll pull item number 4. Any others? Nope. Okay. All other items, would someone like to make a motion?
So moved.
Seconded.
Great. All those in favor?
Aye.
Aye.
Those opposed, say nay. Great. All right. We'll pull item number 4. Okay. I just bring it here. Okay. So let's go to the action discussion, or should we take number 4 now? How would you like?
Whichever.
How do you want to do it now? All right. Well, let me talk about it first, and then we'll pull it. Okay. So we'll continue to the action discussion with the item number 4. Actually, we're going to pull item 4 first. So any comments, concerns? What would you like with item
Yes,
4?
I do. First of all, I would like to say thank you for adding the percentages. But then I looked at,
Get your mic.
oh, sorry. Come over here. Can you hear me now? No. How about now? There, now I can hear myself. Okay. Looking at page 2 of 28 under tab 4, looking at property tax. We'll use this as an example. Okay, when you look at the adopted budget and look at this last column, the adopted budget, in the first 3 months, there's nothing there for as an amount. So I question why that is. And then it's typically adopted budget per period is 1/12 of the total budget. So do you want to
Yes.
that one? Okay.
So if I may, and actually, I appreciate you pulling the item because, again, this will be an iterative process. So on the revenues, we actually are going to be changing. We have that budget line, but a few of the budget lines, typically on the expenditures, the 1/12, expenditures are a lot more consistent in 1/12. In the
Right.
1/12.
And the expenses, the
Yes.
expenditures were 1/12.
Yeah, correct. On the revenues, we don't receive them that way. The first 3 months of revenues always get posted back to the prior year. So the first month we actually receive revenues is typically October. So because of the accrual accounting. So what we're going to be doing and fixing that we're going to make it more of a trend line for that's kind of based on historical percentage received for all of the revenues. So for example, we'll do the first, it'll be 0% for July, August, September, 5% in or 5% in November, 30% in December, then like 10% for the next few months, then another 20%. So it's going to be a little bit more of a curve for revenues because that reflects historically how cities receive revenues.
Okay, that addresses one of my other
Yeah.
questions, because I couldn't figure out the logic
Yeah.
of, from month to month, how much.
Yeah, so on the
Why?
revenue, we're going to need to change the logic. And so for next month, what you'll see, so revenue is one example and we're going to use that 5%, 30%, 10%, 10%. We're going to use that breakdown for all revenues across the board. So we're not going to change it for each one. And then for some of the expenditures that we normally spend a little bit more in the first, the CalPERS is an example, where we make a big payment in July, and then the next, 10 months, we're basically just sort of making smaller payments. We're going to change that trend line or that budget line as well to more reflect how our actual payments go. So you'll see in next month's update a budget line that's a little bit more reflective of how we typically receive both revenues and then pay out certain expenditures. So there's a better comparison. Because as you noted, having the straight line revenue line that doesn't reflect how we receive revenue. So it's not really a useful measure for the first couple months of the year.
Are you going to put some kind of a note
We will. Yep.
talking about,
Yes.
how you're going to set that up?
Yes. So we'll have similar to the 5-year forecast where we had a cover memo that sort of provided, all of the what the projections were all based on. We'll do a cover memo we'll start putting a cover memo on the monthly budget report, and just we'll add some of those notes that, revenues are tracked throughout the year, and we'll kind of lay out that revenue pattern just in like a short cover memo, and then have the report after that.
Okay. Next one is year-to-date actual. That shouldn't be totaled at the bottom, because your monthly amount is the accumulated total for the months preceding it.
For December, for the June, it would be the total for the year.
Right.
Yeah.
And your total, like year-to-date actual for January, that amount should tie to the total that you have for period actual.
I'm gonna pull it up.
So for property tax, it does. You'll see that it ties. For other ones, it doesn't. And the variance year-to-date and adopted column, that shouldn't be totaled either.
It seemed like Tatiana understood that, so that's all that matters because she's
Yeah.
the one that.
Yeah.
You understand?
Yeah. Okay, and one last thing. It seems to me that the more important percentage for council to have is the year-to-date to adopted budget. So instead of dividing by the month's adopted budget amount, divide by the total. And that would, as an example, if you do that for January, which is month 7, then your percentage would end up being 50.66% instead of showing this 127%. 56% of the total budget revenues has come in. So that's what it's telling council. Same thing on expenses. If you look at salaries and wages, that percent would be 53.12%, which tells council, okay, we've used, in 7 months, we've used just a little bit more than 50% of what we budgeted. Does that make sense?
I can listen to the recording.
I will come and sit with you and show you.
Okay,
Does that work?
that works.
Okay,
Okay.
I'll do that. Okay, and that's it. Those are kind of my questions and comments.
Thank you. And if I may, the intent was certainly, this is why we wanted to put it on consent, but have you pull them, we're going to continually refine this. So we appreciate the feedback and the comments. So it'll hopefully by June, it'll be a useful document. So
Yeah.
thank you for the
Oh,
feedback.
it'll be useful before then.
Yeah.
Well, sorry,
I have no doubt.
I had one follow-up question to what you just said, Nick. You said that for the revenue percentages, you're going to change them, right, to like a 5%, but you said you would hold that true for all revenues. But is that appropriate for like property tax versus sales tax versus like utilities? Because wouldn't the way the revenue stream comes in is very different?
It's generally so it's sales tax is probably a little bit more it's generally true just because like sales tax, for example, you get most businesses pay their sales tax on a quarterly basis, right? So we'll have so like every quarter we get a remittance on sales tax, whereas property tax we get it pretty much twice a year, right? So you're right, every revenue will kind of have a different cadence. So I think that's what we're and what we may do, particularly for the major revenues. There's a lot of like the smaller revenues that are actually they're not very predictable. Sometimes they'll come in October, sometimes they'll come in January. But the the major revenues are relatively predictable. So we'll put together sort of like what is our 5-year average of a monthly, that we've received on each month, and then we'll create that trend line that can be but in general, you're going to see most of our major tax revenues aren't going to have any receipts for the first 3 months. Then we'll have, at sort of the quarter, like the October, November, we'll have big deposits. So we'll try to have a trend line that's a historical trend line that fits sort of how we received it in the past.
Sure, yeah, as long as it's, appropriate for that
Yeah.
type of revenue.
I think for me, the format is still a little funky. Like I would rather just see like where we are today, snapshot versus budget, and then whatever, the explanation, right? I think that's important.
You mean like 2 lines instead of a line in a bar?
Yeah.
I think that would be easier to see.
Yeah.
So does that mean like a little bit of a higher level,
Yeah.
like going even one step higher?
Just like actual budget. Yeah.
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 Yeah, we can
Actual budget
certainly.
variance, actual budget variance, whatever that looks
Yeah,
like.
yeah.
And then how much we've spent. So I think that's the point, Tatiana. Like when you look at, we go back to that like salary and wages, for example, right? We're saying for that particular month, you're hitting hundreds of %, but I mean, we've already budgeted the way we think it's going to end up. So it's like just really how much of the total budget are we really thinking about
Mhm.
to date? The 50% of the budget, which we put in the front part
Yeah.
of the report, but
Well, and I think actually the change to the formula that Commissioner Quaid had just mentioned will actually fix that. It won't be 127%. It will be 50%, right? Like on a month. Yeah. So if we make that change, that should make more sense. But I do understand even here we kind of break it down. We still have the categories. We can even go a higher level, just revenue, general fund revenues, one line, actual budget percentage that in the expenditures at like a high level, and then just we break it down by more detail. Yeah, we can certainly add that.
And if the large variance, either way,
Yeah,
explanation.
right.
That's all.
Yeah,
it's simpler to look at.
done. It's basically a table that would support sort of in the staff report and the executive summary where it says 50%, 55%, that you can basically just point to that. Yeah.
That'd be good. I think that'd be helpful.
Understood.
Any risks to the budget at this point? I think we ask this every month.
I think this particular budget, again, this wasn't there are risks that we're facing, but they will materialize more and be addressed in next year's budget, which will lead in well to our next item because I'm going to go through some of those, particularly some of the key kind of issues that we're trying to address, starting to address now that will be in next year's budget. But strictly speaking, like from a percentage of revenues received and percentage of expenditures, like there's no, we don't see any risks for this year's budget. The risks are really those things that we weren't including in this year's budget that are really operational costs that we need to build in for next year.
Ask it a different way. Any of our actions in this budget cycle going to really affect us for next budget cycle? Like, are we settling a bunch of claims that now our insurance is going to go up next year? Like, what actions can we do to help?
Yeah. So I think I think we're getting into the next
Okay,
item
sorry.
a little bit because I think we'll address. Yeah, I think that some of those will not necessarily be fully addressed, but I think they'll be. We can play out. Those will be good questions that I can address, and I just don't want to get too far ahead of ourselves.
Understood. Any other questions, comment? Looking pretty good. It's looking pretty good. All right. Do we have to take a motion on that, Tatiana? Just to receive and file?
Yes.
Okay. Does anyone want to make the motion to receive and file item number 4, the monthly budget report for the month ending January 31st, 2026?
I move that we receive and file the monthly budget report for the month ending January 31, 2026.
I have a second.
I second that.
All those in favor, say aye.
Aye.
All those opposed, say nay. Great, thank you. All right, thank you. We're going to go on to item number 5. I think this is a presentation.
Yes. Good evening, Chair and members of the Finance Commission. Tonight, we're bringing you a foundational presentation on how the city organizes its financial resources, specifically our enterprise funds, special revenues funds, and internal service funds. This topic came up a little earlier this year as something the Commission wanted to better understand and how those funds interrelate. And we think having this framework in place will also help bring forward future budget and financial management items. Uh-oh. I'll just give you oh, yeah, perfect. So tonight we have 3 goals. First, we want to explain how the city organizes its finances, which is through a system called fund accounting. Some of this will be a little basic, but it's also kind of up for the public's purpose as well. Second, we'll introduce 3 distinct fund types that operate alongside the general fund: the enterprise fund, special revenue funds, and internal service funds. And third, we'll explain how each of these funds differs from the general fund, and importantly, how they're interrelated. So this is an informational item, so no action is required tonight, but we do welcome feedback and questions throughout. So unlike a private business, a city doesn't operate as a single entity with one pool of money. Instead, for accounting purposes, the city is organized as a collection of separate funds. Each one is a self-balancing set of accounts used to track resources designated for specific purposes. The reason we do this comes down to 3 things: transparency, accountability, and legal compliance. Different revenues come with different restrictions, and fund accounting is how we ensure that money is spent the way it's intended and that we can demonstrate that the auditors, oversight bodies, and the public. So before we dive into the specialized funds type, it is helpful to understand the baseline, which is the general fund. I know most people are very familiar with the general fund, so we'll just spend a few moments on it tonight. The general fund is the city's primary operating fund. It accounts for all financial resources of the general government that aren't required to be tracked elsewhere. This is where we account for our core services, such as police, fire, community development, community services, and general administration, like our top-notch finance department. Think of it as a default operating fund. Everything that doesn't have a legal home somewhere else lives in the general fund. The total general fund budget expenditure for fiscal year 25-26 were about $43 million. So enterprise funds. Enterprise funds are set up for city operations that provide services to residents and are meant to be financially self-sustaining. These are a little more similar to how private businesses operate. They're funded primarily through user fees or utility rates, and the expectation is that they recover the full cost of their operations, including capital needs and debt service, without relying on general fund tax revenues. The city currently maintains 3 enterprise funds: the Water Fund, the Sewer Fund, and the Arroyo Seco Golf Course Fund. Financial performance in these funds is measured by net position and operating income, just as you'd evaluate a business. The total 25-26 budget for enterprise funds are about $30.7 million between the 3 water, sewer, and golf course. All 3 of our enterprise funds have financial challenges we're actively working through, and I want to be transparent with the commission about each of them. First, current utility rates for both water and sewer funds are insufficient to cover ongoing operations and long-term capital needs. We've engaged a rate consultant and expect to bring rate recommendations to City Council in late spring or early summer. So this is one of those things that we'll need to tackle, which it's not an immediate concern, but understanding our long-term capital needs and our operating costs and where those are going, if we do need to tackle that soon in order to make sure our revenues, the utility rates are keeping up with the cost to provide, clean, safe water to the community. The water fund also carries outstanding debt obligations from prior capital projects totaling roughly $54 million as of June 30th, 2025. And we're monitoring the market for potential refunding opportunities that could reduce annual debt service. At the end of this presentation, I'll turn it over to Michael Bush with Urban Futures. They're a financial advisory firm that assisted the city with the 2016 water bond, and they also help file our annual bond disclosure documents. And he'll provide some additional information on what a refunding would look like and its potential financial benefit. Third, delinquent utility counts have been a significant issue since COVID. To address this, the city reinstated water service shutoff procedures in March of 2026 as our that's we used as our primary collections and enforcement tool. Through the first phase of this effort, more than 50 customers have come in to either pay their outstanding amount or set up payment plans. And just as in all of 2025, I think we had like 8 people come in and set up payment plans. So just through the first quarter of 2026, we've already had 50 plus. So people are coming in. And fortunately, there's about approximately $280,000 that is currently being repaid through these repayment plans. So this is not an insignificant amount of money. And we expect as we go through the second phase that we'll collect even more.
And Nick, was that about a $2 million outstanding liability?
Yes, it's about $2 million. I believe are the active accounts, meaning people that are still drawing water, is a little less than $1 million. The remainder of that are folks that may have left or closed their account. So we council approved a collections agency a couple meetings ago. So we'll be sending those that have inactive accounts through that collections agency to try to get some recovery there.
Are we still giving like? It sounds like only 280,000 are on a payment plan, and there was a little bit under $1 million. So what's the difference there?
So
What are those people doing about their money owed?
The first phase were folks that were actually over a year late, had delinquencies that were more than 365 delinquent. So all of that was the first phase, and so that's why it's not the full sort of $1 million. The second phase, which we're going through now and shutting people off that haven't paid or made a payment plan, those are folks that are going to be 180 days plus, so 6 months plus. So we'll start to see that number come down even more. We'll see a lot more folks on payment plans. We're getting and I have to put this out. I'll put a report, and I can include an update to the Finance Commission of the total outstanding amount. So that 280,000 is just what's on payment plans. Some people did come and make payments, so that not everyone financed their debt or put down 50% is financing 50%. So I can come with an updated sort of aging at the next meeting. But you do get people's attention when they come home and try to take a shower and the water's off. So that causes people to come into City Hall pretty quickly. And then lastly, after going through a visioning process within the last few years, it's been identified that the golf course requires a significant investment to upgrade the outdated amenities and bring them up to today's standard in technology. We're exploring a public-private partnership model that would bring in a private operator to invest in facility upgrades in exchange for a long-term operating agreement, which would allow the city to improve the course without requiring material city capital. So that's our enterprise funds, and some of the threats and things we'll be addressing in the upcoming year. Onto our special revenue funds. So these account for revenues that are legally restricted or committed to specific purposes, typically by state law, grant agreement, or local ordinance. These funds cannot be used for general government purpose, and the budget for each fund has to align with the specific restrictions on the revenue source. The city currently has 36 special revenue funds. Some of the more prominent ones include Metro Local Return Funds, which are generated through sales taxes paid in Los Angeles County. So a portion of the 10.5% sales tax that we all pay when we purchase anything in the county gets returned to cities, typically through a population-based formula known as local return. So most of these voter-approved sales tax based, most of these voter-approved sales tax-based local return revenues, that is a mouthful, are referred to by their ballot measure moniker, such as Proposition A, Proposition C, Measure R, Measure M. I'm sure you've heard us say some of these in the past. And many of these provide transportation-related funding. We also have a state gas tax fund, which supports street and highway maintenance, street lighting, and then the street lighting and landscape fund, and that's also called an LLMD, Landscape Lighting Management District or Maintenance District. And that's an assessment district that covers street lighting and median and programs through property owner assessments. So in total, special revenue funds accounted for about $12.4 million of the total city budget in FY 25-26. Special revenue funds can vary widely from year to year, primarily due to one-time grant funding. So if we have a big, $10 or $15 million grant, this $12 million could be $27 million in one year, and then go in the next year go back to $5 million. So typically in the special revenue fund category, you can see some pretty wild variances, and those are typically due to grant fund receipts.
So
Yes.
these are the use it or lose it funds, correct? When we get a grant for X number of dollars to do parks, it's use it or lose it.
Correct. Grant funds typically are, usually have 5 to 7 years to complete the project, but
Right.
there is a point at which that you can lose grant funds. Not all special revenue funds are necessarily like that. Some of those local return funds I talked about, where we get, a formulaic allocation of 200,000 every year, those typically accumulate, and cities will sometimes accumulate those over 5 to 7 years before they actually spend them, because you need to get, if you're only getting 200,000 a year, over 7 years, you'll have 1.5 million dollars, and that's what you need to pave 1 mile of street, right? So you usually have to let those accumulate over many years before you spend them. So not all of them are use it or lose it, but all of the grant funds tend to have a shot clock.
Yeah, the reason for the question is there was a presentation about city improvements and a couple of years ago, and I don't know about. I think Janet, you and I were both stunned at the number of dollars that we were at risk of losing.
Yes, what I was about to ask, Pete, is how do we account for the grant funding? Because I think what you are talking about over the last couple of years, there were several projects for which we received a grant, but I think you have to spend the money up front.
Yes.
And then you have to apply to get the grant funding after you're done, and then you get the funding. And I think the problem was we hadn't applied to get the money back. So I don't know how that accounting really works.
Yes. So one of the cleanup efforts we had this year was to make sure that as soon as we were, so part of our grant management process now is that whenever well, first of all, we're now asking for city council for permission to apply for grant funds. So they have to approve that first to make sure that what we're applying for aligns with the vision of where the city council wants us to go. Because sometimes you can apply for grants that maybe the city council doesn't actually want. So, because there's the restrictions, there's a lot of strings tied. So that's our first step in the process for grants now, is it goes to city council for approval to submit a grant. Fast forward 3 to 5 months, if we receive the grant, we will then bring that back to city council to accept the grant award. And at that point, and then we authorize the city manager to sign the grant agreement. Now, once the grant agreement is signed, we have city council appropriate both the revenues and the expenditures for the fund. So at that point, now it's on our books and we can track it. What we were finding as we went through this is that sometimes some of these funds were appropriated on the expenditure side, but not the revenue side. So we were spending the money, but then kind of there wasn't a mechanism to show, oh, well, there's uncollected revenue, because the revenue side may have not been appropriated. So by having a much more structured grant process now, where we appropriate the funds as soon as we sign the funding agreement, then all of a sudden it creates a record on the general ledger that there's revenue due and there's expenditures that we can expend. So most of them are reimbursements. We do have to spend the money up front, which is why we have a specific grant fund that we spend out of that. And we typically will see that somewhat negative due to timing, but it's a lot easier to. We were also using this Fund 400 structure, which had just tons of money.
Yeah.
So if we weren't receiving money back, it was kind of hard to differentiate. But we have, what's our grant fund number now? Two something? So 244 we set up specifically just for grants that are reimbursement grants. So we know where all of our reimbursable grants are. It's much easier to manage. So we just started that like literally this year. We probably won't see that on our financial statements. You'll start seeing that, in the June 30, 2026, financials. So
Thank you for doing that, Nick. I know personally, I'll just speak for me. When your predecessor would talk about that, I would just go into a tailspin because I could not understand how we got money. We applied for money, we were granted the money, and then we either didn't spend it and we were in danger of losing it, or don't even know if we spent it, right? And didn't know whether or not we're going to.
yeah.
It was confusing to me at best.
And we also have monthly CIP meetings now with Public Works where William holds their feet to the fire to say, like, okay, we have this money. Where are we on the status of the project? So
yes. So in addition to what Nick said, for these the grants that go into the grant fund, we're actually assigning a grant number to every grant now. So now we can track revenues and expenditures for every grant. So every grant we receive grant A, it'll have a grant number. We receive grant B, it'll also have a unique grant number. So it's not just entering all the revenue and all the expenditures into one pot. It's each individual grant will have its own revenue and expenditure, so we can track that.
William, just a tactical question on that. William has to spend, of his 2,080 hours a year, he has to spend 350 of it tracking a grant associated. Is William's time attached to the grant? It depends. You're starting to sound like a consultant, Nick. Come on, work with me.
or a politician.
Yeah, politician, yeah.
So typically it depends on what you applied for and what the grant will fund. So to be honest, a lot of times the grants don't fund the granting agency really wants bang for their buck, so they don't like to fund salaries or overhead, as they call it. They like to fund, boots in the ground or shovels in the dirt. So typically, if it does fund some staff costs, it's usually because it's a program-related grant. If it's a physical improvement related grant, sometimes they'll set aside maybe 10 or 15% of the grant that you can use toward salaries. And when we do that, William, our CIP manager, we certainly track our time and we charge it to the grant when it is allowed.
Thank you. The reason I asked that question is because during that same discussion a couple of years ago, again, Janet and I looked at each other. Let's just hire someone to manage the grant. Remember that conversation? Oh, Cynthia. Okay. It was
Grants manager.
we needed a grant manager, so now we have William.
So we have the next best thing. We have William.
Grant manager, we will hold. I'll be like Nick said. I'll be asking the department's status on the grants. They will continue to be responsible for submitting reimbursements. I will just ask the questions of where's the funding.
Well, thank you for asking the questions. We appreciate it, and we appreciate you keeping an eye on that ball. And now that you're fully staffed or close to fully staffed, Nick, I'm sure it's going to be easier to do that. But that was just one of the pain points we had a couple of years ago. And then Cynthia and Jen and I are going through PTA. You can see it in our faces as you're talking about this. It's like we were there. Okay, thanks. Appreciate it.
And just a follow up, just I want to make sure I understand, Nick. Don't we? I think we've hired a couple of consultants to actually look for and apply for grants.
Yeah, that's correct. So we, and they're the type of consultants that you only pay when you use them. So it's not like a retainer. So, I will say that actually staff has been relatively successful doing some of these grants ourselves over the last couple months, but there are certain kind of more complicated grants that we certainly use their help in. A lot of them have very technical. You have to provide a lot of technical background on. So we have used that, but I would also say in a city of our size, we don't typically have like tons and tons of grants. So we don't, if you have the process in place, right, the right process in place, then you don't necessarily need a full position that's doing grant management full time. What you typically have is you'll have an analyst in each department who that's like a little bit of their job because there's just not enough work to have 2,080 hours of one person. In a city of our size, there are bigger cities that rely very heavily, that have hundreds of millions of dollars in grants that they get every single year. And in those instances, it certainly makes sense. Here, I think as long as we have now that we have this process in place and regular meetings that, we don't necessarily need a full position dedicated to that.
And I think isn't there like a check ceremony or something on Tuesday? We're getting $1 million grant from through Judy Chu's office for the police, the radio tower, the new radio tower. So we don't have to operate on analog anymore. We can actually operate digitally.
We actually were using Semaphage.
So I think that's
smoke
Tuesday.
signal.
Is that Tuesday at 10 or something? Anybody's interested?
Cool.
I guess so.
I guess the strategy we use at the Y for all these grants is to kind of apply for grants that fund existing things, right? Because you get the overhead, right? And so I'm hoping that as our grants person is looking, they are just funding what we already do, and then it covers salary.
Yes. Oftentimes we have to frame it in a way that it's something new. That's typically just the nature of like public related grants. But yes, that whenever we can fund something we either are doing or we're going to do anyway. I'll give you a perfect example is, I think council had committed to like an urban forest management plan during like last year's just tree ordinance effort. And so now we're really chasing grants for that effort, right? Because if we can either do it with general funds or if we can find a grant for something like that, we were going to do it anyway. But if we can have someone else leverage someone else and use someone else's dollars, win-win. Yeah. Okay, sorry. So special revenue. So some of our key efforts, we've identified 2 areas of work within special revenue funds. Actually, we started to talk. We talked about one of them already. The first was resolving the negative fund balances. As part of our work to catch up on financial reporting and finalize the 24 and fiscal year 25 ACFRs, we discovered that a number of special revenue funds had gone negative. To correct this, we've created a 5-year income statement. So actually, William and his team, Anahi, our new CIP manager, for every single one of our special revenue funds, they created sort of a mini income statement that has our current revenues, fund balance, revenues, expenditures, ending balance, and then we project out 5 years and just have that so that when we're planning our CIPs in future years, we can tell if and when it goes negative. So that's been created for each fund. And this just gives us much better visibility and forces the city to appropriate only within available resources. So that's one of the efforts that we've gone through this year and are using that as part of our planning tools for the 26-27 budget. The second effort is a structural change that the city council approved mid-year, and I think this was also supported by the Finance Commission. So rather than transferring restricted special revenue funds to a central capital projects fund, CIPs are now budgeted directly within each applicable special revenue fund. Again, this improves transparency, strengthens our compliance with legal restrictions, and makes it much easier to demonstrate that appropriate use of restricted funds to our auditors and to the public. Internal service funds. So these are used to provide services to other city departments on a cost reimbursement basis. So instead of each department managing certain costs independently, internal service funds centralize shared functions and charge departments proportionally for the services they use. This structure stabilizes costs over time and makes cost allocation transparent across the organization. Currently, the city's internal service fund is used to accumulate and allocate costs for general liability, and workers' compensation insurance and claims costs. In the upcoming budget, we will be looking into including facility maintenance and equipment maintenance internal service funds, and I'll discuss that in the next slide.
Excuse me, Nick,
Yes.
why wouldn't human resources and IT be part of that?
So long term, they may be, particularly IT, because there's there's like an equipment component to it. We just wanted to kind of focus on the core one. We're mostly focusing on sort of the like physical, like that's why we're using like facility improvements and we're starting with that and vehicle replacements and IT is probably the next step. We just need to eat this elephant one bite at a time.
Fair enough. Thank you. I'll ask the same question next year.
Okay,
Perfect.
sure. We'll see what we can get in. While we have, like I mentioned, we do have one internal service fund in place today. We are actively developing frameworks for 2 additional funds. Again, that we believe will be important to the long-term health of the city. And all 3 of these will be presented as part of the city manager's proposed budget in May of 2026. First, the self-insurance fund, which is the one that we currently have existing, but does have very underfunded reserves. That mechanism wasn't necessarily set up so that the revenues were matching the expenditures. And premiums, I think we mentioned at the last meeting, premiums have increased substantially over the past 5 years. So we're developing a revised structure that establishes recurring annual charges to departments that are sufficient to maintain adequate reserves and adequately fund the annual costs. Second, again, I mentioned our facility maintenance fund. We don't currently have a dedicated funding mechanism for our routine and preventative building maintenance, and deferred maintenance has accumulated over multiple budget cycles. This fund will establish recurring department charges to fund an annual maintenance program. I think 4 or 5 years ago, the council approved a sort of a one-time funding of our facility maintenance, and we've been drawing down, but hasn't been replenished, and we've been drawing down, so we're now down to 0. So it's time to set that up so it's got recurring charges and recurring revenue. Lastly is a vehicle replacement fund. Currently, fleet replacements happen on an ad hoc basis when one-time funding is available. This fund would charge annual replacement costs for each vehicle based on its useful life and projected replacement cost. Consistent with the and this would be consistent with our fleet replacement policy that was adopted by council in January. So to close,
Nick, I'm sorry, can you go back a slide, please? The self-insurance fund, this was a topic of conversation 3 or 4 years ago, and it caused a great deal of consternation. And when you take this to the city council, be prepared to have a lot of conversation around that particular topic, because the transition to self-insurance, our current status, was a couple of years ago. Some folks believe that the advantages were misrepresented, were overblown. We have not received the benefits that we anticipated, and that we should migrate back to the previous state. So that's going to be a tough conversation for you.
No, we should continue it will continue to cause us consternation, just because of our claims history. This year, I believe 3 or 4 years ago, we were paying about $700,000 in annual general liability and workers' comp insurance premiums. This year, we paid $2 million. Next year, it'll be closer to $3.5 million. So we're actually looking at potentially different self-insured retention amounts. Right now, we're at $100,000, which the issue there is that many of our claims hit that self-insured retention level. And just as we all know, every time you use insurance, your premium next year goes up exponentially. So that's what's been happening is we've been hitting our retention level quite often, which will cause and that's going to impact, even if we don't have another claim for three or four more years, our insurance premiums will continue to increase. So we're planning for that. We're looking at different self-insured retention levels so that maybe we keep a little bit more cash in our claims. So we might have to pay out a little bit more for each claim, but if we're managing them correctly, we won't get as many claims, and then our insurance premiums should stabilize because we won't be hitting that level as much. So we're planning through that. I would say that we also are looking at going to different insurance models. Like I think we were in JPIA before, which is the first dollar insurance model. I will say that based on our claims experience over 4 or 5 years, most people won't take us back. We have to demonstrate at this point, we have to demonstrate a couple years of positive claims experience, and then market ourselves, because quite frankly, we're a risk that would cause everyone else's premiums to go up in a pooled environment. So we need to really clean that house over the next couple years so that we do have options.
And Nick, I just want to say, I think that, and I give Nick and Todd and the whole team a lot of credit. This is a lagging thing, right? So these are claims that were on our books for 4 or 5 years. And over the last 2, we've been really trying hard to settle them and get them off the books. Because of course, also, if you can settle them early, it typically costs you less, at least in insurance, in attorney's fees. So there have actually been a lot of claims settled, which is why you're seeing, the rates go up, because now that we've settled them, now they're real, now the insurance companies had to pay out, now our rates are going up. But I suspect it will take a couple of years, but it'll settle out.
Yes. Yep.
Can I make a recommendation to council on that? So if you do change your retention level higher to save on whatever that is, if some of that can get put into this fund.
Yes. So actually what the plan would be, or what if we do recommend a higher retention, we would actually recommend we still fund at the same level as if we were paying the higher insurance premium, but we just keep that cash
in the self-insurance
fund in case there's a claim that, increases. So that would be the plan, the recommendation.
If we pierce through the 100K quite a few times, it sounds like, so how much did we pay out? Like, so we have an insurance premium payout that's happened. So 2 million-ish for this year.
2 million was our premium. Yeah.
How much have we paid in like claims?
Multiples of 2 million, I would say. But that, so even at the higher SIR level, there's been a few, if we went to say 100 to up to 250, what our claim experience was, and Councilmember Braun mentioned this, we are cleaning up claims from a few years ago that, exceeded sort of that 100,000, 250,000, and even 500,000 on some of these claims. That being said, we've kind of cleaned out those big ones that were in the hopper, and going forward, they're just, sort of more run of the mill kind of pothole, like regular kind of type of claims, where you really have issues are on like employee liability claims, a lot of those claims that have damages associated with them, like pain and suffering type damages. So fortunately, we don't have any of those that are currently unsettled, but we did settle 4 or 5 of those over the last 6 months that had significant liability, on the pain and suffering side of that, the tort.
And we
Is that the
settled
right word?
We settled one that was not insured. That was a big number. From 40 years ago.
But where does this show up in our budget, right? I guess that's my.
So it will show up in the claims expense. So at the end of the self-insurance, and I don't know honestly, like the even when you settle, yeah, probably not in January, but and the budget report is just general fund. So these are self-insurance funds. So that's the, but it's not like, and again, the intent is not, we're not trying to hide anything. Obviously, if I was trying to hide, I don't even talk about it. But but we have like, we just were focusing on the monthly report on the general fund for now. Obviously, in the plans in the future, we'd have more funds, but these will show up at the year end. Like in the ACFR, we'll see the claims cost, like there'll be expenses. So they'll be pretty, there'll be good size expenses from a claims claims payout. Now, we've gotten a lot of money, like funding back because of the insurance coverage. So, I guess so it's mitigated sort of our financial hit today, but spread that financial hit over the next 5 to 7 years through premiums.
Yeah.
So our self-insurance fund is negative by how much?
Right now it is, I don't know if I can get back. We can do a little bit more of a deep dive on the self-insurance fund if you'd like at the next, finance commission meeting. I just don't have all the, yeah. Or I can at least, put together kind of a year-to-date report,
See,
but
But there's been a lot of work done on trying to get those
Right.
claims down.
Good.
yeah.
It's great. It's great.
it needed to be though. It needed to be. Nick, one of the questions, again, I'm digging back into history too much and I apologize, but just trying to get clarity because we're cleaning things up this year so that the budgeting process that we're going to kick off in 45 very short days will obviously be colored by this. So we want to make sure that we're prepared to guide everyone through the budgeting process.
And in the budget, as we go through the budget process and talk about the self-insurance fund, which will be a very large topic of discussion through the budget process, we will be able, we'll certainly have like that discussion will include what our, current expenses are. So.
Okay. And someone is maintaining timely request for reimbursement from
Yes.
insurance.
Yes.
Because that is one thing that we did discover a couple of years ago, and we got like $3 or $4 million. We were 3 or 4 million. Somebody opened a desk drawer, and there were unfiled claims in there for $3 or $4 million.
Yeah.
It was stunning.
I've received a number of large checks this year that were reimbursements that I immediately brought right over to finance and put them right in the bank. So yeah, I wouldn't put them in a drawer.
No,
I promise.
no, the checks weren't in the drawer. The paperwork hadn't been filed. Yes.
So if I can, so just real quick, before we have Mike Bush on Zoom, and I think you'll be pretty interested in what he has to say. Just to close out the fund discussion. So in total, these general fund, enterprise fund, internal service fund, and special revenue funds resulted in a citywide 25-26 budget of more than $93 million. So, if we were a business, we'd be a good sized business. So, we do have a lot of fiduciary responsibility and it's sliced and diced quite a few different ways. But, all three of these different fund types have a purpose, are managed a bit differently, but are important to make sure we're maintaining sort of our accountability and transparency to the public. So with that, I'd like to turn it over to Mike. Are you on? There he is.
I'm on, Nick. I'm also joined by Brandon Kafori.
Great. So Mike and Brandon, if you guys want to go ahead and quickly introduce yourselves, and then we'll have Tatiana pull up your slide.
Great. So good evening, members of the commission. My name is Michael Bush. I'm the Chief Strategy Officer at Urban Futures. I've been with the firm this is almost my 20th year. I've worked in your community a number of times over that period of time on different bond transactions, one of which we're going to speak about tonight. I'm joined by my colleague, Brandon Kafori, who serves as a director and did the background analysis on the one page that we're going to be showing you tonight.
Great. Good to be with you tonight. Thank you.
Welcome to South Pass. Virtually.
Thank you.
Hey, Michael or Brandon, could you guys give us like 250 words on what happened in 2016? None of us were here in 2000. We were community members, but none of us were on either the commission or city council in 2016. So just sort of an overview, please.
Well, I can do that as part of the presentation.
Okay, great. Sounds good.
But let me say this to your specific question. Over the course of several years, the city has engaged a few different municipal advisors. I personally worked on the 2013 bonds, and a different firm worked on the 2016 bonds. So I can't speak exactly to what happened.
Okay.
But we can go through where the opportunities lie specifically with that one, because I'm not sure if you're referring to the coupons or some other event that may have happened.
Yeah, I guess the reason, why did we do this in 2013 or 2016, whichever, or both?
Yeah,
and then
okay.
Why are we talking about it today?
So if I may, real
I
quick.
could definitely give you some history on that. When I was first engaged by the community, and I think that the transaction that kind of kicked off possibly both of these transactions of 13 to 16, the city's water system had aged significantly. There was a transaction even before these, which was relatively large, and it had a lot to do with replacement of water storage facilities. And when I arrived, I think in 2013, surprisingly, the water storage facilities in the city were literally 100 years old and made of wood, and falling apart, basically. Within those storage facilities, the mechanics of them were worn out, and you could see, rust and decay on some of them. And in 2013, there was a decision made by city staff to offer tours. I think obviously to the council and other members of the community that wanted to go and look at these facilities to see how they had aged. So I'm very familiar with that transaction, and they were definitely ready. The backlog of capital replacement was, I think at that point, like $100 million. And in order to achieve all that at one time, it would have required very, very significant rate increases. And in fact, I think the rate increases were still fairly significant at the times of these bond issues just to get these accomplished. But I think to where I think your question is leading, there was a lot of backdated maintenance, candidly, of very important infrastructure, and they were seismic risks to those storage facilities. So in order to replace one of that age, you have to build one so you have water storage. Otherwise, you're buying water from another agency at an extremely high rate. So what I think may have occurred earlier in a lot of this structuring of the water system was a building of a new reservoir before 2013 to handle some of the capacity. I think 2013 funded basically a rebuild or replacement of another one. In 2016 was probably a continuation of water infrastructure that had been literally, well beyond its useful life. That's my understanding of it.
And I'm going to just jump in for a minute because I took a tour of our water facilities a couple of years ago, which is very interesting. And we do have the water reservoirs. And I think the council undertook a huge project to build up that infrastructure, as he stated. We own wells in 2 neighboring cities, and our water is pumped from those wells into South Pasadena. But then we also maintain agreements with, I think, Metropolitan Water District and City of Pasadena in case we ever need extra water, which I guess sometimes we do in the summer. So I think you've got the facilities in the 2 neighboring cities that were totally redone. Maybe that's the 2016 bonds, I don't know. And then the reservoirs. There's still one more reservoir that hasn't been done, which you hear us refer to sometimes as the West Side Reservoir. I believe the engineering studies on that in the EIR are underway. So that's the last of the sort of water facility infrastructure that needs to be upgraded.
Yeah, that sounds very familiar. In fact, while these facilities are under construction, you're importing water from that, and it's very expensive. And I think it was included in part of these prices. I mean, it was millions of dollars of just importing costs. while these reservoirs were being built. So with that, I'm happy to go through the slide if there's no other questions.
Sure.
All right. So before you is analysis of a potential refunding opportunity for 2 outstanding water bonds. As the commission, may be aware, bonds typically, once they're structured, they're 30-year transactions. These were 30-year transactions. They're eligible to be refinanced or called after about 10 years. So the purpose of this analysis is to evaluate whether current and projected market conditions support a refinancing that would generate, we'll call it, meaningful debt service savings while maintaining the city's strong profile. I use the word meaningful because there's different designations of what that currently could mean. So for some public agencies, meaningful is, well, what does it mean for rates in the future? That could be one measure. Others, there's a GFOA standard. It's a Government Finance Officers Association. It requires at least a 3% savings. That's like a nationwide recommendation, is that you have at least 3% savings. So I'll walk you through a little bit of the background and how we got to these numbers. So I think part of the good news of this presentation, which there are a few points of positive feedback. First is you can start to work on one of these transactions probably as early as next month, and you can close it sometime in July if you wanted to achieve savings on your debt as early as July of this calendar year. The bonds were issued and would be refinanced as tax-exempt public offerings. They're capital facilities owned by the city. Therefore, under IRS regulations, they qualify as tax-exempt. The city has a current bond rating of A+. We made the assumption with good management based on our view of things, and as Nick pointed out, we provide the annual disclosure reports, that the projects or refinancing would be eligible for bond insurance. And under insurance, we could raise the rating basically to investors to a AA rating. So higher the rating, lower the cost of borrowing. And we do an analysis to ensure that the cost of the insurance is economically beneficial to acquiring it, to make sure that there's more savings as a result of it. And in this case, we believe that to be the case. We did use interest rates as of March 17th. So the market's been moving around, as you probably all know, from what's going on in the Middle East. So there is that little caveat, and the market will continue to move, whether it's geopolitical activities now or from day to day. It does seem to move up and down. We're optimistic that things will calm down and rates will return back down to other levels. To that point, if the council decides, hey, let's go forward, we're going to do refinancing, you can get all the way through the creation of all the documents to do it, and then decide, hey, the bond market isn't ready for us, and you can wait, for the market to improve, and then you can decide when to go in. You don't have to set a certain date, and regardless of market conditions, go into the market and try to sell bonds. We are assuming a universal debt service structure similar to how they were originally proposed and put together, meaning we're not extending, in this case, final maturity of the bonds. So the final maturities from which they were originally issued are the assumption on the refinancing. So in simple terms, this is this interest rate savings opportunity. So as the term declines from 30 years to 20 years or less, the risk declines, and as a result, the rates based on that risk decline with it. So as you can see from this one slide, the primary opportunity centers basically on the 2016 water bonds, which become callable later this calendar year, and as I mentioned, can be refinanced as early as July. Based on current market conditions, that's the March 17th date that referenced, the city can refund these bonds again as early as July, and we project to generate about 7% net present value savings. So that equals roughly $191,000 in annual debt service savings to the city, or $2.3 million in total savings over the life of the bonds once callable. If the city decides to call these bonds, there'll likely be one more period, since they're a 30-year bond. So every 10 years you can call them. So it's possible that they could be called one more time before they finally mature for some level of savings. And as you can see, we also looked at the 2013 bonds. They're already callable. However, they've got a really low coupon. It's a low interest rate. The city and the financing team timed the market pretty well on that one. So our funding currently doesn't make any economic sense. In fact, it has a negative net present value and it's therefore not recommended to review this time. There are times when bonds similar to this might be considered, but that's usually for structural improvements or some improvement to the pledge overall to the water system, but we don't think that's the case here. So clearly, the refunding opportunity is driven entirely by the 2016 bonds. Over the coming months, we will work with city staff. We will monitor the market and continue to refine these numbers as required or as requested. But if the community wanted to move forward, the council and commission wanted to move forward, we could start, probably in about a month and time it to July if there was some need to do that. I also heard a little bit earlier, there is a rate study being contemplated. We could work with the rate consultant to see what these savings would do to rates. Obviously, if you put an additional $191,000 into the system, that might have some small impact on rate assumptions, meaning you have a lower rate increase than may be needed.
What are our current bonds? The ones that you're trying to refinance? What's the interest? What's the coupon on those?
The average coupon on the current bonds?
The 2016.
I can chime in. On average, it's 4.23%. And
So that's the refunded bonds or our current bonds, existing bonds, and so I'm having difficulty reading your thing. You have an average coupon of refunded bonds and then true interest cost.
Yep. So I can explain. So the refunded bonds are your 2016 existing bonds. Those are your existing interest rates. True interest cost is our assumption on what you could borrow at as of March 17th. So we'd be taking it down from 4.23 to 2.94.
I have a
Okay, and then and par versus refunded par?
So the par is the estimated size of the refunding that we would need to issue to take out the existing bonds. So it's a common question, well, what 26 million versus 29 million? The reason is in our current market, we assume that bonds are issued at a premium. So there'd be, a par plus a premium that's generated, and that would be used to pay down your existing bonds.
And I just wanted to clarify and correct me if I'm wrong, either Michael or Brandon. So the 2016 bonds actually they're called the 2016 refunding bonds because they've already been refunded. So the original issue may have been just in 2005. And then there are already refunded ones in 2016. So that's why they would be, is that correct, Michael and Brandon? But then the 2013 was the original issue, right? So the 2013 bond, if we refunded these, would then become the 2026 refunding
Refunded bonds.
So I think that I would say the 2016. I know it's a little confusing. It says water revenue refunding bond. It's because I believe that was already refunded. Is that correct, Michael and Brandon?
That's
Yes.
correct. Yeah,
Okay.
I have your official statement open, and in 2016, it refunded I believe, the 2009 series. So,
All right, then.
yeah.
Then help me out here. So the true interest cost is the new interest cost, right? And then the average coupon of refunded bonds I can replace with average coupon of 2016 bonds or 2013 bonds, depending on what I'm looking at. For the 2013 series will be the 3.13 and the 2016 series would be 4.23.
That's what you're currently paying. Yes.
That's what I'm currently paying on each of those series. So
Correct.
if the true interest cost, which is what you expect the new interest cost is for the 2013, is still lower. I mean, I'm not saying we do it because it is a small amount, but it is still lower than what we're currently paying. You're getting to a negative NPV because of what?
There's basically some issuance costs that are factored in. I mean,
So
usually you need
what
at
is the
least,
issuance cost if we were to do this project on the 2016 bonds?
that's all included here. I mean, we made some rough assumptions, I think, very conservative for your bond insurance. You gotta pay the attorneys to draft documents, underwriter's discount. I don't have that in front of me as to what, we made a conservative assumption, I think based on your
Most
last
of the
deal.
transactions
Yeah.
assume somewhere between 2 and 3%
Yeah.
as the issuance cost.
Yeah.
So
That's something that
can
we,
we
when we
actually
work with this,
see the breakdown of what you're assuming here? And then we should probably actually talk to an underwriter to see how realistic, or are they trying to, like, do you guys underwrite? Or what, sorry, I'm not quite sure what the
We-
relationship here is.
yeah,
Yeah,
so
so-
we represent the city as the advisor. We work directly with the underwriters. And in our past practice, what we have done on the behalf of the city is we will reach out to a series of underwriters through a bidding process and have them bid basically on the transaction. They bid fees. But we independently can look at the market. We have the same, software programs and other views of the market that the underwriters do. But we would evaluate underwriters on two things primarily. One is what would they charge to do the transaction. The second is, what experience do they have and what performance has that experience led to? So we can look at whether or not in prior deals in other locations, if they've priced well in the market, meaning that the spreads to treasuries or whatever MMD spread they're looking at is tight. And we can see whether some firms perform consistently better than others. And so we would make a recommendation to the city on an underwriter that one has competitive fees, but also has performed well with this very specific credit, which is a water revenue utility credit.
So your typical bond, bond.
So can you also then, sorry, explain to me, when you're saying these bonds are typically issued at a premium, the coupon would actually then be higher than this true interest cost, right? Because presumably, if you're being able to issue at a premium, you're paying a coupon that is higher than current market interest rates. Is that what you're assuming here?
That's correct. Yes, true interest cost factors that in and your yield and how much proceeds you generate. So
Why is that just convention for this market that you pay a higher coupon than and issue at a premium?
it is correct.
Yeah, investors want liquidity, so they're willing to do it. They're willing to pay the premium.
So to clarify, what I think I'm hearing is we would pay down the 26.53 par with 29.325 for the benefit of a reduced interest rate to 2.94 over the next 7.8 years to generate the savings. Is that correct?
Correct.
And just to a typical.
And what are you assuming then the actual coupon rate is on this bond?
A standard interest rate scale for this type of credit assumes 5 coupons at a premium, but the yields are starting in the 2% range, and that's how you get to your TIC. I would think of true interest cost, TIC is what we refer to it as the average interest rate when you factor in the premium, the coupon, and the yield. So this is a way to think about just roughly on average, how much is the borrowing cost? So that's, in our world, obviously we're serializing bonds. There's some moving pieces going on, but that would be sort of the average rate.
To the chair, if I may.
Sure.
I just wanted to just in general, sort of a general bond refinancing team. It typically made up of a financial advisor who would represent the city and to make sure that they're sort of reviewing all of the documentation. Then you would have bond counsel, which is a team of a legal firm that specifically specializes in bond documents because there's indentures, there's official statements, there's a bunch of legal requirements when you issue bonds. And then there's the underwriter who actually sells the bonds. They're the ones that market it to their clients and then sell the bond and would be the ones that would get ultimately be the ones that determine the interest cost. And then the third piece is typically there's a fiscal consultant. They're sort of an independent firm that does the financial projections for the official statement to show the bondholders, what the expected sort of revenues for the water bond are that are securing this debt. So that's why the issuance costs tend to be the 1 or 2% because you're paying a number of advisors or specialists in that field in very particular areas. So those are the three sort of areas. I would just say for tonight, we just asked, Mike does fiscal advisor services for a number of cities. He's done it for us in the past. We just wanted a back of the napkin to kind of give an order of magnitude of what it might look like to see if there was any appetite from the commission to, have the staff talk to council about exploring this, right? Because at that point, we would need to get a fiscal advisor on board and then start down the road of, getting the bond team on board. If this was something, again, if the commission was interested in us exploring, we could move that forward at this time and begin that process. Otherwise, the whole idea is if there's some savings and we're doing a rate study, maybe it's a good time to look at this. Otherwise, we don't have to necessarily move forward with anything. Just wanted to put that forward for commission consideration and feedback.
Yeah, thank you very much for bringing this forward. And thank you to Michael and Brandon as well too. I'm just wondering, is there any sort of risk associated with refinancing? Like, so for instance, obviously it has to be marketed. You got to have, people that actually buy the new bonds. So a lot of this is, I'm sure, predicated on the assumptions you talked about, but do you typically see like where, for instance, sometimes assumptions just aren't realized and what happens in that situation, right? Like if you don't find enough new bondholders.
Yeah, it's a great question. There's two answers to it. The first, most of your financing team traditionally works contingent, meaning they don't get paid if the bonds aren't sold. They all know that. That's pretty much industry standard. There's one exception to that, and that is the bond rating agency. So all these bonds go through a Standard & Poor's rating process. As I mentioned, your bonds are A+. Once we go to the rating agency and we get a rating, and let's just say to your point, the market moves away and we decide not to go forward. Unfortunately, they're the ones that are not. They want to get paid. So they don't care if you don't go forward. So that's the one risk you have there if you decide not to go forward. Secondly, as it relates to the market, there's two structures to issuing debt that kind of determine how you enter the market. One is a competitive process where you set a date certain to sell bonds, and you basically solicit to underwriting banks to provide you a bid on a very specific day at a very specific time. Typically, those are done for high-rated transactions. General obligation bonds from schools are a good example. Very large public agencies, City of LA, City of San Francisco, et cetera, do transactions like that. The problem with those structures is that day could be a horrible day in the market. You're kind of stuck with it. And in that case, you might not get bids, or you might only get one, or not enough to really evaluate a great opportunity. What we contemplate here for South Pasadena's credit specifically is what we refer to as a negotiated transaction, meaning you negotiate not only the underwriter you bring in, but you can also negotiate the day you go into the market. So if the market is not favorable to these interest rates, you don't have to go forward. The other remaining component of this transaction is when as it was mentioned, the bond documents are drafted. So there are resolutions, there's an indenture, there's an official statement, a continuous disclosure agreement, there's a few different things. One of those resolutions that the council would be asked to approve sets parameters on what the minimum amount of savings they'll accept to go forward. And it tells the financing team, you can sell bonds based on your schedule, provided that the savings are at least this much. And if we go to the market and on that day, we can't reach that threshold, we can't sell the bonds. So there is a backstop once the council approves the financial documents that the transaction will be done with a minimum amount of expectation or it doesn't go forward.
Okay, so what I'm hearing is there might be one aspect that's a sunk cost if we proceed, right? The bond rating. So maybe we just need to understand what that amount is. And then the only thing I would say is obviously savings is always nice, especially if we feel pretty confident that that potential risk of the cost is kind of minimal or in the grand scheme of what we could save. But I think it's more just also resources because it sounds like a lot of this is done through, firms such as yourself. But if it takes away internal resource time or whatever that is, then, does that, matter to the 190,000 that we're saving versus other priority projects where the team may want to be focused on. So. But I
Fair
think
question. There will be definitely staff time. It'll primarily be from the water enterprise folks that will have to work through the bond rating presentation, and they'll want to speak with the rating agencies about the performance of the system itself.
I'm sorry. Oh, I'm sorry. I wanted to just say, I think what we got better at in the last year and a half, and I'm looking at Nick, is allocating staff time related to water matters to the water fund, which is then our revenues come from the water rates. So it won't hit the general fund. Is that correct?
Yeah, as far as sort of like the cost in the cost of issuance is if we do issue, it is paid out of the bond. So it wouldn't necessarily hit that bottom line. It would reduce savings a little bit. I think from a staff time standpoint, again, a lot of the work is up front. There's a lot of data gathering because again, we have to put our best foot forward. We're really trying to sell the bond. The investors want to know, what our water sales are. Are there any, threats to the system? What's the condition of the system? That type of thing. So, as far as, staff time, like we could certainly work it in if it's a significant enough savings. I mean, at a 7% savings, if council deems that as a significant enough, the staff would certainly, work it in. There are a lot of the complicated work is done by consultants. So for us, it's a lot of mostly data gathering and providing information.
I would just go ahead.
Oh, please.
Okay.
Sorry, just one more question. Because I know it's been kind of raised before that we may possibly need to go out to market for sizable bonds in the near future for other projects, right? So how does this, I mean, knowing that the ordinary, citizen, they just see debt, they just see bonds, right? They may not necessarily see like, oh, this is for savings, but I guess, and I don't know if this is something you can comment on, Michael and Brennan, but like just the perception of like refinancing with bonds and then going out, say 2 or 3 years later with a much more sizable bond, does that impact?
So I would say these are a lot less sort of public facing than if we did a general obligation bond that is secured by, voter approved property tax revenue. So these are already an existing debt. So it's not like you need to, it doesn't increase your debt. It doesn't go against sort of your debt ceiling. It actually, reduces it. It is already an existing debt on the books. It doesn't require voter approval because it's secured by water revenue bonds. So it's sort of a different makeup. So we certainly have to go to council to report to get the team in place and to get approval of the official statement. And as Mike mentioned, sort of if there's parameters for selling those. So there's that interaction from a public standpoint, but it's a lot different than sort of a property tax secured general obligation bond. That would be so they're for two different purposes. There's always there's always the potential that the general public could confuse the two issues or conflate them. But there's no there's no vote that needs to be taken on a water revenue bond where there would be on a general obligation bond.
to me, Nick, I think you're asking for some direction. To me, at least personally, it's a no-brainer. It's an interest rate play. You're going to save a lot of money. And so I would suggest you explore the idea and proceed, but happy to gather comments from the rest of the commission.
I'm more than happy to explore it. The numbers, I'm still trying to figure out how this all lines up, but I'm sure there's some Excel with a lot of links in the back that maybe you can share.
Sure, and I would say
Yeah.
like what Michael and Brandon were asked to do was just super high level kind of.
But I'm just looking, right, like,
attitude.
so how, like, okay, we have NPV of savings 2.08. You have total savings 2.5, and you have average annual savings of 191,000. So how many years is that? Like, what,
We
right?
have a
And
cash
your
flow we
average
can say
life
you
is
pay.
7.8. Like,
Yeah.
somewhere in there, it's not straight as arithmetic. It's the math doesn't quite work directly. So I don't know what the links are in the back, but I would love to
At a
see
high
it.
level, sorry, at a high level, NPV is net present value savings. So those
Yes,
are
I
discounted
understand
back.
that.
Yep. And so then the total savings is on a gross basis. Average annual savings are essentially you take your remaining years, so 26 to 39, and divide that into 2.5 million to get your rough annual savings. So, but we'd be happy to provide the backup.
Yeah, I would say if we move like these schedules get incredibly detailed, if we like move forward, so it would not be this is sort of just like again back of the napkin. If there was a moving forward, we would certainly have much more detailed and be able to show much more detailed.
But I concur with
Formulas.
Nevin. I think it's worth exploring, and I think we would recommend that to the council. And obviously, it would just take, that look at the numbers and what is that potential sunk cost that it may cost. But it's helpful to know that the city can set parameters, right? Like how much savings we would want before we go forward. So.
Any other comments? Great. Thank you.
Perfect.
You need a
And
motion or you don't need any?
No,
Okay.
it seemed like there was direction. We'll work with Zen and bring something forward to council for consideration.
And Ely, I think you made a good point about optics. I mean, I think this is sort of a refinancing of existing debt. So I think it would just be messaging. And actually by saying we are going to, because this is coming with the water rate study. So if we can save some money on the debt, we may not have to raise the rates as much.
Fair.
Yes, that's a perfect message and a real practical message. So, and I just wanted to thank you, Michael and Brandon, for joining us. Appreciate it.
Thank you, Michael. Thank you, Brandon.
Thank you.
You.
Thank you.
You're welcome.
Before we move on, I just want to circle back to, since we're still on number 5, just my general comment about the sort of the 3 areas is, we spend a lot of time on this commission focused on the general fund. And I would like us with time and experience that you guys are getting to really start to also look at the other 2. We're only talking about a third of the budget half the time or more than half the time up here. And so I would like to us get to that point at some point. And I know you guys are on a great path and it sounds like there's a lot of work being done in the background, but hopefully we'll get some additional reporting in the future. Fair enough. Great. Tatiana, do we have any public comments on this item?
No, we don't have any public comments.
Great. All right. All right, we're gonna continue then. Communications, City Council Liaison, Ms. Braun.
Just again, thrilled at this meeting. Thank you, William. Thank you. Thank you, Tatiana. I think we're making great strides. And thanks to all of you commissioners, as always. You guys do such a great job. And to Zen, our treasurer. I'm sorry, Zen. We got to make sure we include Zen.
So that's exactly what I'm gonna do next. Any comments from the city treasurer?
No, I mean, we'll take a look at this bond. We have talked about it in the past, but it's good to get some numbers out there. I just want to make sure everyone's math adds up.
Great. Any comments from staff?
Just real quickly, our next meeting in April, we'll be putting forward the annual investment investment policy update. And I believe we're going to invite Peyton Rigel to do their kind of an annual investment report. So just all things investments next week.
So Jim is not around. I think he's traveling on that day. Madison can do it. Unless you guys want the full team, I guess we can go ahead with just Madison, or do you want to wait for a date that Jim is available?
No, I think it's whatever you recommend, then. We're fine.
All right.
Great. Communications, thank you, Nick. Any communications from commissioners? Renee? Cynthia?
Just like to say thank you again. I think you guys are doing such a great job and it feels good. To just kind of be able to have a pleasant meeting where we're getting a lot of information. We're not struggling to understand what's going on. There's no bickering back and forth. So thank you.
Anything? Anything?
Thank you for coming so prepared. It really helps.
Ditto. Thank you.
Yeah, I just wanted to say I love the conversation. I think that we're really coming together as a commission, and I think everyone's input is super valuable. Everyone brings a different element to it, and I think we're really on a great path. I think one thing that I think I heard about this, and maybe Janet, you could help us. There may be some student interns that are joining commissions. If we could possibly get one, we would love one.
Sheila's kind of heading that up. I don't know I know there's 3 of them that on different commissions, but I'm not sure we got a finance commission
I
person.
came up here to talk about something totally different. Was not prepared to talk about a youth commission member, but it looks like I was because I approached. But I can follow up with the city clerk's office about that.
That'd be great.
There are a number of commissions that did have youth members join recently, so that it was.
And just to be clear, the youth commissioners are non-voting because that was unclear in the old law, but they're non-voting. But it'd be great. It would be really great.
It'd be fun. Bring us a cool element. Yeah.
I just wanted to remind the commissioner of what he wanted to recommend as a meeting place, the chair as a meeting place.
Oh yeah, if we can instead of sitting up here next to each other, sit at that table, maybe at the library community room that we did that one time, and we can just kind of have that conversation more fluid if it's not too much work, Tatiana.
No, we could certainly, if commission would prefer to meet in the community room, for a couple meetings, give it a try, see how it works out. I know it was a lot of positive response to the last time we did that. We can certainly schedule the April meeting for that and then give it a try.
Great. Thank you.
Like it.
Cool. Everyone good with that? Yeah. Awesome. Let's do it. All right. With that, I think we are adjourned at 8:03. Thank you, everyone.